studying your last two. I swim with tea when they turned in. The staring out to mute and can lend a pole that some kid died.
In this slide, we'll explore an important relationship between GRIP and investment income, one that often confuses new corporate tax learners. A common misconception is that every type of corporate income increases the corporation's GRIP balance. After all, if investment income increases taxable income, shouldn't it also increase GRIP? The answer is generally no. GRIP is primarily built from active business income that is taxed at the general corporate tax rate. In other words, income earned from the corporation's normal business operations, such as manufacturing, retail sales, consulting services, or other active business activities can contribute to the corporation's GRIP balance when it is taxed at the general rate. This is why the left side of the slide shows business activities flowing into the GRIP wallet. As the corporation earns qualifying active business income, its eligible dividend capacity grows. Now look at the right side of the slide. Investment income includes items such as interest income, rental income, capital gains, and dividend income from investments. Although these amounts are taxable and are important for calculating the corporation's overall tax liability, they generally do not increase the corporation's GRIP balance. That's because GRIP is designed to reflect income that has been taxed at the general corporate rate on active business operations, not passive investment income. Think of the GRIP wallet as a special rewards wallet. Only qualifying active business income earns new reward points. Investment income may increase the corporation's overall profits, but it usually doesn't earn additional GRIP capacity. This distinction is extremely important for dividend planning. A corporation may report significant taxable investment income and still have little or no additional GRIP available to support eligible dividends. The key takeaway is simple. Business income builds GRIP. Investment income usually does not. Whenever you're trying to determine whether income increases the corporation's eligible dividend capacity, first ask yourself one question. Is this qualifying active business income taxed at the general corporate rate? Or is it passive investment income? That single question will often lead you to the correct answer. Now let's look at a more advanced concept: how investment income indirectly affects GRIP. Earlier, we learned that investment income generally does not build GRIP. However, that doesn't mean investment income has no effect on the corporation's ability to pay eligible dividends. Its effect is simply indirect rather than direct. The process begins when a corporation earns two different types of income: active business income and investment income. Active business income comes from the corporation's normal business operations, while investment income comes from sources such as interest, rental income, dividends, and capital gains. Investment income is first identified and calculated through Schedule 7. One of the important roles of Schedule 7 is to determine the corporation's level of passive income for tax purposes. The amount of passive income then becomes important because of the small business deduction rules. If the corporation's passive investment income remains below the annual threshold, it generally continues to receive the full small business deduction. This allows more of its active business income to benefit from the lower small business corporate tax rate. However, if passive investment income rises above the threshold, the corporation's small business deduction limit begins to shrink. As passive income continues to increase, more of the corporation's active business income may be taxed at the general corporate tax rate instead of the lower small business rate. This change affects future dividend planning. Although investment income itself does not create GRIP, the way active business income is taxed influences how the corporation's GRIP balance develops over time. That's why investment income has an indirect relationship with future GRIP growth. The comparison at the bottom illustrates this idea. corporation earns only $20,000 of passive income, which is below the threshold. It continues to receive the full small business deduction and can plan its future dividends under the normal rules. Corporation B, on the other hand, earns $80,000 of passive income. Because its passive income exceeds the threshold, its small business deduction limit is reduced. This changes how its active business income is taxed and affects its future eligible dividend planning. The important point is that investment income does not flow directly into the GRIP account. Instead, it influences the tax environment in which the corporation operates, and that can affect the corporation's future GRIP balance and dividend strategy. The key takeaway is this: investment income affects future GRIP planning indirectly. It does not build GRIP by itself, but it can influence how active business income is taxed and how much eligible dividend capacity the corporation develops over time. In this final slide, let's connect everything we've learned about Schedule 7, the small business deduction, Schedule 53, and eligible dividends into one complete picture. The process begins when a corporation earns two different types of income. The first is active business income, which comes from the corporation's regular business operations. The second is investment income, which includes interest, rental income, dividends, and capital gains. Both types of income are first analyzed in Schedule 7. Schedule 7 separates active business income from investment income and determines the corporation's passive investment income for tax purposes. Next comes the passive income test. The amount of investment income is compared with the annual threshold to determine whether the corporation's small business deduction limit will be affected. If passive investment income remains below the threshold, the corporation generally continues to enjoy the full small business deduction. However, if passive income exceeds the threshold, the small business deduction limit begins to decrease, and more of the corporation's active business income may be taxed at the general corporate tax rate. This is where Schedule 53 becomes important. Only qualifying active business income that is taxed at the general corporate tax rate contributes to the corporation's GRIP balance. Schedule 53 keeps track of this balance and determines how much eligible dividend capacity the corporation has available. Once the GRIP balance has been calculated, the corporation can declare eligible dividends, but only up to the amount supported by its available GRIP. Those eligible dividends are then paid to shareholders, who generally benefit from more favorable personal tax treatment. The checklist on the left summarizes the entire process. Schedule 7 separates business income from investment income. The small business deduction rules determine how active business income is taxed. Schedule 53 tracks the resulting GRIP balance. Finally, that GRIP balance determines how much eligible dividend the corporation can pay. The panel on the right also corrects several common misconceptions. Interest income does not build GRIP. Rental income does not automatically increase GRIP. Capital gains do not automatically create GRIP. And perhaps most importantly, not all taxable income contributes to the GRIP balance. The key principle to remember is that GRIP is generally built only from qualifying active business income that has been taxed at the general corporate tax rate. Investment income certainly influences the corporation's overall tax planning, but it does not usually flow directly into the GRIP account. If you remember just one idea from this lesson, let it be this: Schedule 7 separates the income. The small business deduction rules determine how active business income is taxed. Schedule 53 tracks the resulting GRIP balance, and that GRIP balance determines how much eligible dividend the corporation can designate for its shareholders.